All right, welcome everyone. Here we go. The very last live stream of the year. Let me see if I can get the right camera angle on here. What's up, Vinicius? How you guys doing? Hope you're all doing good. Yes, you're the guy who sent me an email for applying as a potential moderator. And while I'm on that subject, got some really exciting news for the new year. We are expanding the live trading room in a very big way. So we are looking for people to join the team. We're looking for hosts, moderators, anything that you might, and the skills that you might have that might help us grow the live trading room. You're free to send an email to tradingroom@the5ers.com. Already have a lot of emails, a lot of people looking to join, so very, very happy about that. What's up, Henry? How's it going? Man, you're always in here. You're always in here. I think you won an account, right? Did you get that account? Let me know how that happened with that one. So yeah, today I want to talk about, there's a lot of, you know what, before we continue, I just want to say that I have a bit of a headache and potentially a fever as well. So this is going to be a short one, and I might end it a little bit earlier if it gets too bad. We'd love to see us reopen to Americans as well, but it's what it all comes down to is just legal, regulations and all of that. Would love to start onboarding Americans as well. Hopefully, we'll be able to do that in the future. So today I want to talk about 2025. This is the last day of the year, and what I hope you guys have gone through your journals and your trading journals. Not only your trading journals, but also your personal journals. Stop loss filled on a year. Not just your trading journals, but didn't you win an account? I thought you won an account. Okay, maybe not. I'll have to double check that. So I went through my my journal, my personal journal, and my trading journal. Went through what I saw this year. Actually, I've seen that there's been a lot of stress in relationship to trading for me. So I wanted to kind of dig deep and look into that. Like why was there so much stress in relation to trading? And I figured out that the levels of stress definitely went up quite a lot when I was more focused on the lower time frames, doing more day trading and scalping. And what I found was that my personality is definitely it's not in line with the day trading style of trading. My best trades of the year, one of my best trades was actually taken in, I believe, October, the short on Euro USD. And so most of my best trades have been taken and in the second half of the year. And those have been more long-term swing trades or position trades. And that's also those are also the trades that align with my personality. So going into next year, I'm going to focus more on swing trading and trading based on higher time frame structures and more cycle plays where the technicals align with the fundamentals. And I do think that for me, that is what's very important to me. I will forward this to the team. The comment in here. I will forward this to the team. And of course, we are at the end of the year. We got on in holiday season and everything. So it's not a lot of activity. I do believe that support is still on as usual though. Okay, so this year or today, I want to focus on. I've seen a lot of people talk about. Yeah, I think this is actually quite an important comment because the big trades that I've taken this year did happen when we saw an influx of an influx of volatility in the markets. And basically what this means is what we should be doing is making sure that we're not trading when the conditions aren't right. Like, what conditions are good for you? And what I've noticed is there are conditions that can last for actual several months when my trading performance is not as good. So it's important to, take it easier during those times. Okay. So this year, I've been hearing a lot of people talk about how 2025 will be the year when we have a market recession. Okay, so I want to talk about that theory. Why are so many people talking about 2025 as a potential top in the market? I've gone through many different theories, looked at many different news websites, newsletters, and tried to see what are the common themes here. Okay, because sometimes what you want to do from a macro analysis perspective, and for me, it's important to have an idea of the macro going into the year to see what can we expect in the new year. Sometimes it's quite good to take as much information as possible and then try to see if there's where are these ideas correlated. And there are a few key points that I want to cover today, and those are the yield curve inversion. I also want to quickly touch upon the credit cycle, and I want to look at how does the yield curve inversion and the current credit cycle, how does these two ideas align with a potential market top in 2025? And then I also want to look at Bitcoin, because Bitcoin, I'm looking at Bitcoin and I'm projecting a top in Bitcoin mid 2025, which also aligns with the overall market. I'm also going to look at a couple of confirmations of this, both from a price action perspective and what economic news releases we want to look at for confirmation of this theory. And then because of this, we want to look at some cycle plays in the Forex market going into next year. Where do we think? Yes, we are currently live. We are live. Let me know if you do have any questions. Obviously, this is going to be more of a slow live stream. I know many of you are probably not. There's a lot of people probably not trading today, which I think is the best thing to do. So yeah, we want to look at confirmation both from a price action perspective and also which economic news releases are confirming this top, and then just look at a couple of ideas. So first, what is the yield curve inversion? So a yield curve is inverted when the short-term interest rates, like the 2-year treasury yields, are higher than the long-term interest rates, like the 10-year treasury yield. So in healthy economic conditions, the long-term yields are higher than short-term yields, and this is reflecting the additional risk and the uncertainty associated with lending money over a longer period of time. And when the short-term interest rates exceeds the long-term rates, this basically signals market expectations of slower growth or even a recession. And this might happen because of a flight to safety when investors are anticipating economic trouble, and they might then buy long-term bonds, driving the prices up and yields down. And why this is important is because every US recession since the 1970s has been preceded by an inverse of the yield curve, typically with a 6 to 18 month lag. We will see this is not true in this current cycle, but what's interesting is that we're actually right now, we are seeing signs of a yield curve inversion. And I wanted to show you what this looks like in TradingView, how we can actually plot this in TradingView. These are very, yes. I'm gonna include every chart that we're gonna be looking for here. I'm gonna try to give you as much information as possible here. And if you think this type of analysis is interesting, do your own research on this as well. Look at the details of the yield curve inversion and how it can be used. I'm not going to go into extreme detail on all of this because obviously we don't have that much time. It can take quite a long time. But I want to look at the basics here. So let's open up a new layout here. And what we want to do here is we want to go up here in TradingView, and we're going to type in US 0 to Y, and this brings up the United States 2-year government bond yield. And then we're going to press the minus, and we're going to type in US 10Y, and that is the 10-year. We're going to add this to TradingView. We're going to invert the chart. We're going to add a line at 0%. Basically, what this means is when the yield curve goes below 0, are there going to be any in-person event in the UK in the new year? Well, I would love to have. I don't have anything planned, but I would love to have one. I mean, there are some discussions. I'm talking with. I've had discussions with Victor and Alex and Abe, and potentially creating something like that in the future. But nothing set in stone. But it's definitely something that I would love to do, and something that I'm thinking about. I mean, it's definitely true that we have months of the year. Some years have longer sideways trading markets. But then again, you have to understand that the markets are fractal. You might have some months of the year, you have sideways price action. And then other months of the year, you have very volatile markets. But even within those sideways trading markets, you'll find trends on the lower timeframes. And I think it's very important as a trader to be adaptive. If you're an active trader and you're making a living trading the markets actively, and you're looking for many trades as a day trader, obviously you're not too influenced by the overall market conditions and the overall market direction. But it's very important also to have this idea of trading with the overall trend. And if the overall trend is in the range bound market, you might want to make sure that you have an idea of where the range lows and highs and the range EQ and all of that is. But yeah, if you're a position trader, a swing trader, there's going to be a month in the year where you're not going to make any money. You might be holding a position through the whole month, right? So if you're a day trader, if you're trading on a low time frame, this doesn't really apply much. We are not going to be offering a $1 boot camp for New Year's. Right, so this is the yield curve, okay? And the yield curve, when the yield curve goes below 0, we have a yield curve inversion, basically. And like I said, why this is important is because every US president since the 1970s have been preceded by an inversion of the yield curve. And then we have something called the uninversion, okay? And the uninversion, I'm pronouncing that right. I've been trying to pronounce it right all day. So the uninversion will signal a, basically what happens is it signals the end of tightening. And this is when the Fed stops raising rates and begins cutting them. And the short-term yields starts declining faster than the long-term yields, leading to that inversion. And this often signals that the economy is heading towards a recession as the central bank is acting to stimulate economic growth. And as you can see here, the last uninversion happened in September, around September 2024. So around September this year was when we had the uninversion. And this usually happens about 6 to 12 months before a market downturn. Because remember that uninversion usually happens 6 to 12 months before a market downturn. And also, the amount of time that the yield curve was inverted, I believe it's like 36 or 37 months, and that's a record. It's never been inverted for that long in the past. And remember that uninversion happens about 6 to 12 months before a market top. Okay, so that's the yield curve. And that's one of the reasons why a lot of people are talking about a potential market top mid 2025. I also have an indicator here, as you can see, and this indicator marks out the yield curve inversion. When it goes below red, it goes below zero. And as you can see right here, went below zero here, went below zero here, and then went below zero. And then you had the uninversion right here in September this year. Another idea that I've seen a lot of people talk about is the credit cycle. So what is the credit cycle? It's also called the business cycle. And I believe it's a cycle that lasts from anywhere between 7 and 10 years. And the credit cycle is basically the natural progression of the credit available and the borrowing conditions in an economy. It describes different phases through where credit basically expands and contracts over time. And this is obviously influencing economic growth, asset prices, and overall financial stability. And the credit cycle plays a very central role in sharpening the broader business and economic cycles. And changes in the credit conditions will impact consumer spending, business investment, and the overall market behavior. Does the yield curve and credit cycle affect every currency? Well, okay, so let me put it this way. This affects the overall market conditions. And of course, when the overall market conditions is shifting from, let's say, risk on to risk off, if we go into a overall recession, obviously that will have global impacts on global markets, and that might influence different changes in trends in the market. Let's say, for example, that when the Fed starts cutting rates, the US dollar would potentially form a top, right? And then you could be looking at, like right now, we see that the US dollar is at a cycle high and Euro USD is at a cycle low, is what I would describe it as. And then, of course, if you have if you see the market going into a contraction and a recession, that might mean that you have a shift in the dynamic of the overall currency market, which would mean then that the Euro USD being, in possible cycle lows might actually shift and form a massive uptrend going into next year. And that's one of my trade ideas, right? Going long Euro USD when this ends. So the credit cycle, now I'm going to be pulling this up here. There's going to be a lot of lines, a lot of things on the chart here, but bear with me. I'll explain exactly what we're seeing right here. First of all, we want to look 6 months forward from the uninversion of the yield curve. Remember, the beginning of recession usually happens 6 to 12 months after the uninversion of the yield curve. See. So let's say, it's 6 months from September would be, what would be the average? Let's do 9. 9 months, that would be around, let's say around that time. That would be June 2025, which is mid 2025, and that's about 9 months after the uninversion of the yield curve. So around this time, right? Which I'm going to be marking out with a horizontal line. I'm removing that one. I'm going to be making this big. Make sure it's visible. And now I'm going to be adding the overall credit cycles. I will not be taking any trades today. I'm not trading today. I am still in Euro USD longs. Been in those for many weeks now. And nothing is set in stone in trading. We all know that. Ideas like this one that has been true for all previous recessions since 1970s can end this time. It might not be true. Last time it happened might have been the last time that it was actually true. We have no idea what's going to happen in the future. No idea. So what I'm saying here is, you know, this idea that you have strong convictions loosely held, you know, you want to have this idea, and if everything aligns to this idea, as long as you don't have anything contradicting this idea, you want to be putting on risk on this idea. But as soon as that idea is invalidated, you take that risk off. As soon as your idea is validated, you take it off. You don't want to be marrying an idea. I mean, if this doesn't hold true, then, you know, I'm not going to be trading that idea. I don't care about that. I'm forgetting all about that, and I'm moving on to the next one. Well, I think the main reason here is to create better trading conditions for the indices. I believe that the overnight swaps became lower and the conditions became better, basically. Okay, so now the bottom indicator is the inverted yield curve. Now let's add the business cycles. Okay, so these are the previous and current business or credit cycles. So here you have the housing bubble credit cycle, and then you have the post-financial crisis credit cycle, and then you have the current credit cycle. Now let's look at the phases of these credit cycles. Again, like I said, there's going to be a lot of lines on here, okay? So bear with me. Let's first take a look at the housing bubble, and we're going to be looking at the different cycles here. Now, the housing bubble did actually start earlier, but I don't have the price feed going further back, obviously. So you first have the expansion phase. Now, in the expansion phase, you have credits are basically growing and borrowing becomes easier. And this is, of course, fueling economic growth and rising asset prices, rising optimism. And then you have euphoria. This is the peak and the euphoria. This is where asset prices is eventually reaching an unsustainable level before the credit conditions are starting to tighten. And then, of course, here you have the 2008 financial crisis. This is the contraction phase of the housing bubble. And in a contraction phase, the credit conditions is being tightened, and economic activity obviously slows down or contracts, often leading to a recession like you saw here in 2008. Then after the contraction phase, you have stabilization, where basically the economy and the credit markets are stabilizing after a downturn with deleveraging and cautious rebuilding of portfolios. Then the parts of the stabilization phase and the recovery phase will a lot of times be the beginning of the next business cycle or the next credit cycle. And then you have the post-financial crisis credit cycle right here, where a very, very big expansion right here, and it is, goes on and on and on, and it's almost like this could be compared to the Dow theory, but the Dow theory is basically, the Dow theory is interesting because in the Dow theory you have the accumulation phase and the public participation phase, and in the Dow theory the stabilization and recovery is part of the accumulation phase. I would say that stabilization is accumulation phase, and then the recovery and expansion is part of the public participation phase with the Dow theory. And then, of course, you go into euphoria, and contraction is part of the distribution and markdown phase of the Dow Jones, the Dow theory. So if you're interested in that, definitely do some research on that. It can really help you time the tops and the lows in the overall market. And now you know the overall phases of the credit cycles. And this is fairly basic stuff, right? The Fed is increasing and decreasing interest rates for USD, and they're also going to be using quantitative tightening and easing to help stimulate the economy. And this is what creates these credit cycles. Basically, the availability of money creates these cycles. So where are we in the current cycle? It's important to note that the bear market, if we can call it a bear market, in 2022, we had a downtrend. Let's move to the weekly chart here. On the S&P 500, we obviously had the highs and the lows. Now, this is an obvious bear market, but was it really a recession? Now, looking at the thing is that the US economy was fairly strong during this time. I believe that GDP was actually growing and the job market was still quite strong. So the numbers didn't really point towards an overall massive recessions in the market. Yeah, and that's also, this is a good comment, right? We had the COVID crash, the pandemic, in March of 2020. When we had that pandemic crash, and which was, a black swan event, they printed and just pumped in a massive amount of liquidity in the market, record levels of liquidity into the market. And I believe that this cycle right here, or that downtrend, was basically a pause in the overall cycle. It was a reset of the conditions created in the COVID crash. So it's still part, weirdly enough, I see this as part of the expansion cycle. And then after the expansion cycle, we enter euphoria. Now, I think most of you can agree with me here that from here, I wouldn't really say that this is euphoria. We could probably split this up in two different sections where you have like pre-euphoria and then the real euphoria, when Bitcoin really exploded and you started trading towards that 100K level. But we've really seen some crazy markets during this time. And what I believe we see now is, I believe we're currently in either late stage expansion or late stage euphoria, which means that the next phase that we're looking at is contraction in this current credit cycle. And if you look at the credit cycle, you see that the contraction comes in right where you have that line that I draw that was 9 months after the uninversion of the yield curve. And I do look at this as we're going to have a last push to the upside, a last surge to the upside on risk assets like the stock market, Bitcoin, etc., and potentially also a last push on the US dollar. But eventually we are going to enter that correction phase of the cycle, that contraction, which I believe might come in around the mid 2025. So that's the overall credit cycle and the inverted yield curve. And if you compare this to the Dow Jones theory, definitely recommend seeing if you can find a comparison of that, because that can definitely help you with confirmation. We're going to look at one aspect of the Dow theory that might help us see signs of this happening, because it's one thing you're saying like, oh, I think it's going to happen right here. There's another thing saying, I think it's going to happen here, and these are the indicators and tools that you want to have in your arsenal to look at for potential confirmation of this. In Charles Dow's time with the Dow theory, he talked about confirming trends by comparing two different indices. And the indices that he used is the industrial average and the transportational average. Basically, what he did look at was divergences in price. If the industrial average had higher highs and the transportational average had higher highs, then we were in an uptrend, a bull market. But if one starts showing lower highs and one higher highs, then that is a sign that one of the averages are lagging behind. And there's also this concept, there's a lot of information here, so kind of have to get it all in line here. There's also this concept of market breadth, right? Where you have indices like the S&P 500, where there's a few key player in the S&P 500 that is a big portion of the overall index. Like, for example, you have, I believe, Nvidia is like 7% of the overall S&P 500. And if Nvidia is performing extremely well, then that will influence the overall structure of the S&P 500. But then you have other indices that is more balanced, right? Like the Russell 2000. And instead of using the confirmation that Dow Jones used, or that Charles Dow used, we can use the US indices. So I'm going to see here if I have that chart somewhere. Many different layouts up here. Bear with me here. We'll see if we can find the actual confirmation that we're looking at. Okay, so what are we seeing here? Not that one. Okay, so let's just create it here instead. So what we want to do is we want to look at divergences between the US indices, specifically the S&P 500 at the top and the Russell 2000 in the middle, and then we might as well add the NAS 100 at the bottom. Now, what does confirmation look like? We're basically looking for confirmation of a trend. What we're seeing right now on the S&P 500 is we are creating a lower high. Let's assume that that is a lower high. Zoom in a bit more. That's the high on the S&P 500. That's a lower high on the US 2000, the Russell 2000, and that's a lower high on NASDAQ 100. Now let's assume that the S&P 500 comes up next year, maybe, in next month or something like that. You might have a higher high on the S&P 500, but what if we never break that high on the Russell 2000. We might just have, we might, you know, come up here on NAS 100. Then what we see here is that the S&P 500 is creating a higher high, while perhaps the Russell 2000 is not creating a higher high. This tells us that the bullish price movements that we're seeing is only concentrated on a few markets, on a few assets, not every asset. It's not a, you might say that this is not a public participation phase. This actually means that only the very strong assets are showing growth, while the rest of the market is showing a decline, a contraction. And this is confirmation, possible confirmation of the trend ending. So that's one of the tools that we want to be using to confirm what's happening right here. Now, we also want to look at some economic news releases, right? Because that's obviously very important when looking at this, because recession is, undeniably confirmed when there is, clear economic news releases confirming a top. And the economic news releases that we want to be looking at is first GDP. We want to be looking at the gross domestic product, the GDP. We want to be looking at that and see, is it increasing or declining? If the GDP is declining while we see a divergence in price action of the indices, that might signal an incoming recession. We also want to look at the non-farm payrolls. We want to look at the employment numbers. We also want to look at the manufacturing PMI and retail sales. These economic news releases are going to come out in Q2 and Q3 of next year, and that's the economic news releases that might confirm a recession. Of course, when they're confirming a recession, then the downtrend has already happened in price. So price will most likely be the leading indicator here, as always, to a recession. But if this price action confirmation of a divergence between the indices are happening when we also have, we're at around the time or getting close to the contraction phase of the cycle, that might signal that it's time to take risk off, okay? It's time to take risk off the table. It's time to sell stocks and look for other opportunities. Let's look at Bitcoin, okay? So by using a combination of the inverted yield curve and the credit cycle, we've come to the conclusion that in the middle of 2025, there is a potential for a recession in the overall market. Now let's look at Bitcoin. Okay, so Bitcoin is, of course, Bitcoin is a risk asset, so it's dependent on the credit or business cycle as well, but Bitcoin has its own cycle. And Bitcoin's cycle is based on the halving. You have currently 4 different halvings. The first one in 2012 and the latest one in April 2024 this year. And this is basically the cyclical nature of Bitcoin. Bitcoin starts an uptrend after the halving, and then approximately about let's see, how long is it? About 500 days later, you reach a top. On average, 500 days. That means, it might mean 400 days or 600 days. But on average, after the halving, it takes about 500 days for Bitcoin to mark a top. So when is that? Well, that is the average days from halving to top creates a top in August 2025. We go back to S&P 500. we mark out here, and we're going to write Bitcoin average days halving to top. And when is that? August 2025, which is here, okay? The end of the contraction phase. Now, this also adds to the idea of an overall market top, because, you know, make sure you understand that Bitcoin is never going to have a bull market if the overall market tops out, and vice versa, okay? You will not see risk assets perform well in a recession. Bitcoin is never going to rally in a recession. So when we have a recession, that's the Bitcoin market top. And it just so happens that the contraction phase of the current credit cycles align with the possible top of Bitcoin. So here we're starting to create an idea, a tradable idea. On Bitcoin, we want to be taking profits on Bitcoin. I've already taken quite a lot of profits on my Bitcoin positions, but we want to make sure that we start looking for an exit of the overall crypto market around the midpoint of 2025. Not only do we want to look at an exit of Bitcoin, we also potentially might look at a short position on the Bitcoin to play its cyclical nature to the downside. Okay, so let's try to wrap this together with the Bitcoin and this theory, and then we will move into the Forex market. Let me try to just, there's a lot of information here, and I don't really have any notes on this, so I just have to remember this theory. And this is also a really good practice for me to really imprint this theory for myself by basically, remembering on the top of my head the whole structure. So, confirmation. There's a clear correlation between Bitcoin and the S&P 500. And that's what we want to be looking at right now. Remember how we talked about Charles Down using confirmation in price action, looking for divergences in price action between the industrial average and the transportational average. And today we want to look at the difference between the S&P 500 and the Russell 2000, or just an average of all the US indices. Well, with Bitcoin, we want to look at price action divergences between Bitcoin and the S&P 500. Because one very clear idea here is that the last top on Bitcoin, I know because I was actively trading Bitcoin back then. I've been trading Bitcoin and investing in Bitcoin since 2017. So I very vividly remember this. I sold Bitcoin here, and I was very happy because I timed the top on Bitcoin. Now, of course, when we had this up move again, I thought I made a mistake by selling Bitcoin, but eventually it just happened to be the fact that I did actually sell the top on Bitcoin. I was a little bit early though. But what's interesting here is when a lot of people looked at this and said, well, that's a top on Bitcoin. Look what happened on S&P 500. The S&P 500 is the red line right here. Well, the S&P 500 continued its massive uptrend. Now, this is on the weekly chart as well. Bitcoin dropped, but the S&P 500 continued to the upside, which caused Bitcoin to form a bottom and continued to the upside. The Bitcoin then formed two massive double tops. We have a high on the S&P 500, high on Bitcoin, higher high on Bitcoin, higher high on the S&P 500, but then we broke that low right there. We broke the low on the S&P 500, and that marked the downturn in Bitcoin. So to really time and confirm the Bitcoin top here, we want to be looking at the S&P 500 as well. And if you're looking at the S&P 500 right now and you compare it to the price action of Bitcoin, it's actually very, very similar. If we remove the S&P 500 chart right here, we'll look at the daily chart of Bitcoin right here. You see that Bitcoin is at a resistance level right here. I mean, a support level right here. with equal lows and somewhat of a range. If we break below this level, we might expect price to perhaps come down to the 70K to 75K region. Now, let's compare that to the S&P 500. What are we seeing on S&P 500? We are seeing price reacting to these lows right here, creating somewhat of equal lows. And if we break these lows, we're probably going to go down to the next level, which is that one right there. And if we break these lows on the S&P 500, we have a slightly bearish shift, which means that assets that are more volatile at the S&P 500 is most likely going to be overreacting to this break to the downside. And one asset that loves to overreact is Bitcoin. So if the S&P 500 breaks this low, Bitcoin most likely breaks this low down to the level below, while the S&P 500 probably finds a support around this level, unless we enter a overall bear market, which I don't think we're going to do. So with this example, you're seeing that there is a very clear correlation between Bitcoin and S&P 500. So if Bitcoin is breaking its bullish market structure, but the S&P 500 is not breaking the market structure, then I don't think we have a top in Bitcoin. But if the S&P 500 and Bitcoin confirms each other in terms of price action around the time of the contraction phase of the business cycle, I think that's when we have to look at we have to accept the top, basically. I think that's what I'm trying to say. Okay, so that's a lot of information. That's a lot of things here, pointing towards a possible top in 2025. What I want to do now is I want to mark out. I'm going to remove the business cycles here. I'm also going to be removing these. This is analysis that I did back in 2022 and 2023 when we looked at a potential market shift in the S&P 500, and basically also we predicted the upturn here when we saw the higher highs and higher lows. That's when I started buying heavily, going risk on, and also the time when we went all in. Well, not all in, but we started buying a lot of Bitcoin as well. So these theories, they work. You look at market structure in high time frames, it's quite easy to time the market, unless you want to time it on a day, but give or take a few weeks, it's not really that difficult. Okay, so we want to add to the S&P 500, we want to look at the dollar currency index. We want to look at the dollar currency index and its relationship to the S&P 500. Now, I haven't looked at this, but I would be curious to see what the overall relationship is between. Actually, I don't really have much time, so I think it's better to just go directly to the Forex market. But basically what I want to be looking at is I want to try to see, is there any correlation between or inverse correlations between the uptrends and the downtrends with the US dollar index and the S&P 500. This does require more time to analyze those. So there's nothing, it's not super obvious. What we're going to be looking at is some of the majors though. Again, I don't have much time. So, but the US economy, I think the US economy is in like late stage, like I showed here. I think the US economy is in a late stage of something compared to euphoria and expansion. So I think we are in an area where we're going to see a big reset or a contraction in the market, basically. But let's just quickly go over some of the Forex pairs. More importantly, the one that I'm looking most closest on is Euro USD. And we have two options. Now, like I've said in the past, now obviously the current structure of Euro USD looks very bearish. And I have my long positions here on Euro USD, and I'm happy to get stopped out. I don't really care about getting stopped out here, because if we do get stopped out, or if I get stopped out on this position, which is a rather small position, remember I'm looking to add quite significantly to this position once a break of structure is signaled. We almost got a break of structure here when we had a possible break and retest of the highs here on Euro USD. That did not happen. We broke down and we're still in a downtrend. If we, however, start printing something like this, then I will add massively to this position, because I think that wherever we are going to reverse on Euro USD, we'll see a quite directionary move next year. And I think if it's going to be here, I'm looking for a move that is potentially going to take us up here to that level. And we're looking at from current levels, we're looking for about an 800 pip move to the upside. And if we are able to add risk to this idea to the upside, that could potentially be a huge trade in 2025. If we break this level to the downside, I'll get out of this position with a relatively small loss, but that's even better, because then we have a possible level down here where we can create a cycle low for Euro USD and play that. I mean, imagine if Euro USD starts to break down, trade down here, and then in Q2 next year, we have economic news releases signaling a potential, slowing down of the US economy. With this type of price action, that's going to tell me that we have a potential cycle low. Now, there's a lot of things left to do in this analysis. Currently, I'm looking at the daily for Euro USD. Now, there's still a lot of things to do here in terms of this analysis. What I wanted to do here in this live stream is just present a theory that I'm working on. And the first, when I'm creating these macro influenced long-term theories, what I do is I select data that confirms the theory. I then look at data that would debunk this theory, and then I try to see which ones are strongest. If there's clear data that debunks parts of the things that confirms the theory, then I remove that from the overall theory, and that's what I've done now. But I also want to make sure that I can create a theory that goes against this theory. If I can't do that, then that means that this current theory that I have is quite strong. But the next phase of this theory is creating actionable ideas. I've already shown you one actionable ideas for this going into next year on Bitcoin, and I'm currently working on describing an idea on Euro USD with combining the idea of the inverted yield chart and the credit cycle, and also and also the cycle theory, because obviously, and yeah, this is quite important comment right here. I need to make sure that there's no confirmation bias here, which is like, I know we're never going to be able to completely remove ourselves from the need to be right, or the idea that we really want to be right. So I want to make sure that okay, so here's how I debunk the theory. I wouldn't bet against Trump. Dude is already getting foreign CEOs to pledge billions of investment in the US economy. Perception is very important. Well, okay, so but you do agree that there is going to be a top. That's just how the markets work. We're never going to be able to go up indefinitely. There is going to be a top. Now, if that top is in the middle of 2025 or at the end of 2025, I don't really care about that. What I care about is the fact that the evidence are pointing in the direction that we are closer to a top than a bottom. And we are not in a bear market. So understand what I'm saying here. We are not in a bear market. In a bear market, we would be thinking, when is the next expansion phase? When is the next public participation phase? Because the money is made buying right before the public participation phase. The money is made in accumulation. We're not in a bear market now. And I have the chart of Euro USD here, but when describing this, I should probably have the chart of the S&P 500 up. We are not in a bear market. We are in a bull market. And the way you have to think in the bull market is, first, buy the dips, never short, do not short the S&P 500. Buy the dips, be long, be risk on. But also think, when is this ending? And what do we need to look for this to be the ending? You have to ask yourself, are we in the middle of the bull market? Are we at the end of the bull market? I believe that we are in the end of the bull market, but I'm not going to take any trades based on this until there's confirmation. And confirmation is the thing that I talked about, the divergences between the indices, right? And the if you want to have like strong confirmation, then look for a 2 consecutive decreases in GDP numbers, for example, things like that. But then price action will have already confirmed that well before. So am I betting against Donald Trump? Let me put it this way. Why do people love, okay, not love, well, the people that like Donald Trump, they really like Donald Trump. And they do so, I believe, because of the things that he is promising. I mean, why do anyone like a politician that gets elected? Well, it's because they get elected on what they promises to do. They are liked because of what they say they are going to do in the future. The market is currently rallying on the idea that Trump will put certain things in motion. But let me just throw this idea out there. What if Trump, like 99% of all the other politicians out there, what if Trump promises a lot of things, but it's not going to do everything that he promises? How is the market going to react to that? Well, it's already priced in. The things that he has promised to do is already priced in. When he comes into office, we already know what he's going to do. It's not going to rally when he does the things that he promised to do, because that's already priced in. However, if he does not do everything that he promised to do, that might create confusion, uncertainty. And we might retrace parts of the move that has already been priced in. That's just an idea. That's just an idea. It's just speculation, right? It's just pure speculation. But yeah, that's the thing. If you overpromise, the chances are that you will underdeliver. The market does not like underdelivering. The market likes overdeliver, like overpromising and overdelivering. Anything else is just not going to be good for the market. Oh yeah, I mean, this is also very good. It's a very good comment. I mean, you got to trade what you see and not what you think will happen. But you also have to prepare. If you're gonna trade what you want to see, like if you're gonna be trading what you see, then ask yourself, what are you actually seeing? You know, and well, okay, let me put it this way: if you're gonna be trading what you see, what do you want to see? I mean, first you have to create a plan. What do you want to see? And then trade that when it's actually happening. And I'm creating this plan and this theory going into next year, creating this idea of what do I want to see for me to short the S&P 500, short Bitcoin, potentially go long on Euro USD and short USD. That's a bit problematic though, because I have to look at Euro USD's relationship to US recession. And it might not be picture perfect. So I'll have to look at, have to look at other pairs versus USD, see how they have reacted in previous contractions, previous recessions. But I do believe that this could be the big trade of 2025. Okay, guys. That's that's it for me today. I would like to thank you all for joining here today. And these theories that I've presented here today, I'm going to be continuously updating you throughout 2025 during the live streams that we're going to have here with the 5ers, and updating you on my plan, on what I'm seeing, and any developments on this. And I highly recommend that you follow along, because when you understand the cyclical nature of the markets, man, trading becomes easier. And also, I want to tell you guys about the plans that we have for 2025. So what we're going to be doing is we're going to be having longer live streams. We're going to be having more hosts, and we're going to be leveling up the whole experience, a lot. So I'm really looking forward to having you all in here next year, and I'm really looking forward to growing this experience with all of you. Remember, it's the reason I'm doing this, the reason why we are doing this, is because of you guys. This trading room, this trading show would not have been here if it weren't for the great engagement and the positive spirits that is the 5ers trading community. All right, guys, thank you for joining here today, and I hope to see you all next year. I'm not going to be here tomorrow. I'm going to be releasing a new video on the basis of market structure tomorrow. But then next week we are back to regular schedule. Yes, Michael from Traded Pool. Man, you guys really loved him. The views on that live is absolutely skyrocketed. I have to get him on. I have to get him on again. I want to interview him. So make sure that if you have any questions, make sure to write them all out in the comment section here, and I will have an interview with him and really pick his brains on exactly what he does to be so successful in the Forex market. All right, guys. Again, take care and see you all next week.
Hi guys, so thank you very much for watching the video. Now make sure you like and subscribe, and most of all, go into the YouTube and check our other content that we provide here at the 5ers. We'll see you in the next one.